Hello, everybody. I welcome you again to the course on economics in economics to us. And as you know, I am carrying over the series of the components of GDP. And so far, I have explained to you about what are the macroeconomic indicators. And the indicators include consumption pattern, investment pattern, and further we'll be going for the government expenditure pattern also and the net export. So that together comprises of the GDP of an economy. Now, in my last lecture, I explained to you about the consumption functions and its components. Today, I am taking up the second component, that is investment function and its components. And investment is one interest area which we all, land upon because deciding about where to invest, how to invest is very, very important in today's time, where we all are having so many options of investment nowadays. So, in this presentation today, I will be telling you about what all components we have to keep in mind and how to decide upon investment and how to look into it, but from the economics point of view. So, today you will be also be learning about its application, about the components and then its applications in a very small span of time. I'll be explaining you this. So let's start with the presentation now. So firstly, about the investment function. The investment, so I'll start with the definition of investment. Investments in a layman's language is basically, to buy shares, stock, bonds, security, either going in for the banking sector investment, that is in the form of the RDs, FDs, or post office savings. So this is what investment scenario we follow in maximum all the countries, and this is the way of investment basically. But this is not real investment because it is just a simply transfer of your existing assets to and putting it or channelizing it to a systematic way of keeping your money rather. So this is called as the financial investment. But there is a very famous economist known as Keynes, and he has given many theories in economics. So according to Keynes, real investment adds to capital stock. That means whatever capital you have from past also, it investment just add to that stock. This thereby increases the income and production and purchase of the capital goods as well. So here it is not only about investing in bonds, securities, or FDs, RDs. It is also about adding to your existing stocks. So Keynes has propounded two theories of investments, and he has helped these two concepts of investments which are used in calculating national income are gross investments, that is total amount spent on new capital assets in a year. That's the gross investment. Either capital assets means that is in the form. So capital assets is basically, the kind of, investments that you do in the form of, either buying up a land or, again, financial investments, which I just mentioned to you. These are all the part of, capital assets only that you create in a year. So all the investments that you do in a year, which basically generates revenue to you for a longer period of time. It can be land, machinery, it can be even your jewelry, even your financial investments. So whatever you do in a year, that's a gross investment. That's one of the investment concepts which we take in national income. The other one is the net investments. That is whatever gross investment you have done minus the depreciation value. Now this depreciation is the whatever assets you buy, obviously, being since we are expecting that it will generate revenue for a longer period of time, the life of that machinery or life of or that property obviously will depreciate over the year, because if suppose it's a building, the building will surely depreciate. It keeps on deteriorating over the years. It doesn't the value of that place will surely be increasing. It must be accelerating in nature, but the building which you have constructed, that will have a depreciating value, because the things that are used in building up that gets deteriorated over the time. So even same thing is with the machinery. You will always see that the machinery works better, and gives you a better production in the initial years of its usage. But as its usage keeps on increasing, the output that you generate from a machinery starts declining. So that's the depreciation. And since it's the assets are for the longer period of time, we do not depreciate the value in a single year. We divide it, the value of that asset over the period of time by taking an average year. Like suppose I have taken up a machinery in my production function, or in my production of goods and services, and I expect, now expectations play a very important role in economics. So I expect that this machinery will generate, will work for suppose like 20 years. So what I do is that I'll divide the depreciation, that machinery or the value of that machinery, by taking out an average for 20 years, that every year this machinery will be depreciating this much. And I keep a depreciation fund also, so that in the 20th year, when this machinery will be completely off, it will stop giving me production, or I'll stop using it for production. I can use that depreciating amount for either in between for maintaining it, or either in purchasing at the end of 20th year. So this is how we work for depreciation. So net, whenever net value or net worth is attached to investment, or in any of the components of economics, you'll find a net worth. That means that the depreciation fund amount has been deducted from the gross value. So here is the two important concepts, that's the net and the gross investment. Now investment function is actually fy, which is that investment is a function of income. Yeah, we all do that, isn't it? If suppose I have a very small amount of income, my investment will surely be small. But if my income is very high, my investment will surely be higher. So there is a direct and a positive relationship between income and investment. So this is what is the investment functions all about according to Keynes. So here you have learned two concepts, that is what is financial investment, what are the components of investment of national income investment which we take, and what is the investment function, what is the relationship between investment and income. Now we'll start with very two important determinants of investments. What determines your investments, how you should decide upon that whether you want to invest in this particular instrument or not. Yeah, even the capital assets for that reason. So there are two component determinants. First is the marginal efficiency of capital, MEC, and second is the marginal efficiency of investment, MEI. Now marginal efficiency of capital is the highest rate of return expected from an additional unit of capital assets over its cost. Okay, so this is the marginal efficiency of capital. What are your expected highest rate of return that you expect from an additional unit? Supposedly I already have jewelries, okay, and I want to add more to my gold collection. So what I'll do is I will surely go to the market, but I will rectify that whether this investment of mine will give me long returns, or long and sustainable returns or not. Otherwise I have to see that whether it will decline or not. Similarly with us, tangible assets like property. Supposedly I want to invest in lands, but for that I have to see that whether this particular, whether I'm telling you, first and second both in combination, about what the marginal efficiency means, is that whether I want to check upon whether this additional unit that I'm going to buy, whether it's my gold jewelry, whether it is my property, what return it will give to me in future, whether this per unit addition into my already existing stock will give me better returns or not. So this is how I'm going to use, and this is all based on my expectation. Let me tell you, this is very important in economics, and there are this is what is forecasting also, where we are going to predict that what in future will happen. So this is very important. And marginal efficiency of capital tells us the same thing, that it's the highest rate of return expected from an additional unit of capital assets over its cost. Okay, whatever you're paying, you have to get a return over it. Similarly, marginal efficiency of investments, it is what return you are getting from the investment in the capital assets over the period of time. So these we'll do in detail now. So, marginal efficiency of capital, as just now I told you, according to John Maynard Keynes, he has given a general theory. According to it, MEC is the rate of profit expected in a year from investment done on capital assets. Marginal efficiency of capital, it is basically the rate of discount which would make the present value of the series of the annuities given. That is, yeah, the expected rate that you are expecting. So, what we important factor in MEC is, it's about the rate of discount. Rate of discount is basically based on the interest rate that is we are getting from the banks on the whatever investment we have done in the banks. The interest rates that are there in the economy basically is the rate of discount that we consider for taking out our expected value. Now, just now, you can see on the right hand side, SP, that's the supply price. What is the supply price? How do you determine a supply price of a particular capital assets or in which you are going to invest? And that is all based on the rate of discount. That is, the existing interest rates R1, R2 and Rn are the prospective yields or the series of expected annual returns from the capital assets in the year from 1 to n. So this is the formula that is there. SP, that's the supply price, is equal to R1. So this is the formula, that is, for any expected value that you have to know about or the price, you take the returns that you expect from it in future, okay, or the returns that you expect upon the 1 plus I to the power, whichever you're taking. So this is the supply price formula which I have just shared with you, but it has a very very important component, that is I. So whatever is your expected return for R1, R2, till Rn into 1 plus I to the power n. For the second year, whatever is your expected return, that R2 into 1 plus I to the power 2. So this way you keep on adding up for the expected years, how many years you expect your return to be from any this thing. So you, from any investment rather. So whatever is the supply price, you get the present value of that supply price. So supply price in present, whatever you are investing in present, whatever you are paying, and what your expectations are in future, you will be able to judge upon it this way. So supply price of the capital asset SP is the price at which you are going to acquire this asset in the present time, depending upon what are its expectations of returns in future. So R1 is what are you expecting your returns for the expected returns in future into 1 upon I for that particular year. First year, suppose that's I is the interest rate. So this is what the supply price is, to get the things you are acquiring, so that you can know that whether you are paying the correct price for it in today's time or not. Okay, so this is how you're going to evaluate your investment. But MEC overall, what is its use is that, suppose the MEC or the marginal efficiency of capital, sorry, if you get that greater than your interest rate, then it is worth borrowing the money and investing in that particular asset, because your expectations, okay, of that capital investments, or what your return you're expected in future, is very high than what interest rate you are paying for it in today's time. Are you getting it? So your returns which you are expecting from that particular capital investment is very much higher than the cost that you are bearing on that investment through the interest rate that you are paying for that investment, that is either through loans or anything. So you are going to, it's worth investing. But if your marginal efficiency of capital is lesser than your interest rates, then it is not at all worth investing in that particular uh, investment tool, because your cost of taking up a loan and investing in that particular instrument or investment tool is very much higher than what you're expecting your returns to be. So obviously when your expected returns are not up to the mark and you're paying very high cost for it through the interest rate, then why is it important, or it is not at all useful to invest in such an instrument. So this is what is the role of marginal efficiency of capital supply price in is in deciding about your investment pattern. So same thing what I just told you, I'm going to explain you through a graph. Yeah, so application of MEC is, this graph is basically explaining you the relationship that is there between the marginal efficiency of capital and investment. So there exists a negative relationship between these two basically, and you can see that the MEC curve is negatively sloped also. So as the interest rate is basically falling down, as you can see, when R0 was the interest rate, the investment was I2. But as the investment interest rates has fallen down from R0 to R1, you can see that the investment has increased. Reason, and this investment can be for sure will be has been done taking into consideration the MEC will be higher in future. So now since the interest rate has also fallen down, the cost that you're going to bear for this investment by either paying interest rate for that particular loan that you have taken for investment has reduced down, and your expectations for future will surely increase. So you can see that how the marginal efficiency of capital is expected to be give higher returns in future, so your investment is increasing in that way. So, as the interest rates falls from R0 to R1, investment increases from I2 to I3. But MEC again depends. Now the MEC, which you can see is falling down, it is all depends upon what is your expected return from that particular investment for future, and in comparison to the cost that is in the form of interest rate you are paying for that particular investment. And if you're expecting that your cost is very much higher than what are your expected returns from an investment, then MEC will surely fall, and vice versa. This also depends on the extent to which there is a change in the investment in comparison to the change in the interest rate. Supposedly your investment, the extent of investment is higher. So if your extent of investment is higher, then your fall in the interest rate, obviously your expectations will surely be very much high for that particular investment, because you're investing a higher amount, though the reduction in the cost is not very high. So if it is then and if you expect a very high return from that particular investment in future and you get return, then your marginal efficiency will remain same. Otherwise your marginal efficiency will also fall down. So this is how, these are ways in which the marginal efficiency helps you in deciding upon your investment pattern. Now we come to the second component, that is marginal efficiency of investment. Marginal efficiency of investment is the rate of return expected from a given investment on capital assets after covering all its cost except the rate of interest, because we have already seen that in marginal efficiency of capital. Now the decision to invest depends upon the market rate of interest. If rate of interest is high, investment rate will be low, and vice versa. There always exists a negative relationship between rate of interest and investment. Hence the investment curve is negatively sloped. So rate of interest and investment, just now we have seen it in the last one also, that what are your expectations. But you might get confused now between these two, but I'll explain you. See, marginal efficiency of investment is directly related to all its cost, all the interest rates that are there. So it depends upon the rate of interest, but also in keeping in mind the cost, other costs that are related to that particular investment. You have to, take that also into account, for deciding upon what is the marginal efficiency of that particular investment, not only interest rates. So the marginal efficiency of capital, whatever capital investments that you are going to do, what expected rate you have from that investment, okay, from that capital that you are changing, that stock, the change that is occurring in your stock. So that change what you are going to see. And here it is the relationship between the investment and rate of interest. It is all not dependent on what expected rate of return you are going to get in future. It all depends upon what is your rate of return interest, and here the decision to invest depends upon the market rate of interest. If rate of interest is high, your investment is low, and vice versa. So there is a very simple relationship, not at all complex, but here there in the, I'll just explain to you in the next slide about the difference in two. So for now, you understand that is just the relationship between investment and the interest rate. We are not talking about any efficiency that is there in the capital that we have changed. The stock that is changed in the stock of capital that has occurred because of the investment. We are not at all considering that. We do not take into account the rate of discount that is there. It is just the simple relation of the interest rate and investment. Now, elasticity of investment demand curve, as just now I told you in the marginal efficiency of capital also, that the degree to which the change is occurring in investment due to change in interest rate is a very, very important thing to be kept in mind. So elasticity of investment, that is EI, is actually the percentage change in investment upon percentage change in interest rate. So that is what is the elasticity of investment. If elasticity of investment is greater than 1, then investment change is highly responsive towards the change in interest rate, for sure. If elasticity is less than 1, then investment change is less responsive to less change in interest rate. If elasticity is equal to 1, then investment change is equal to the change in interest rate. If elasticity is 0, there is no change in investment due to change in interest rate. So in the less elastic is the MEI curve, the lower is the increase in investment, because this is as a result of fall in the interest rate. Supposedly there is a fall in the interest rate, but if the curve is less elastic, that means the change due to change in interest rate, the investment is not changing too much. So the lower the increase in the investment as a result of fall in the rate of interest, you say that the MEI curve is less elastic, because yes, the uh, responsiveness change in investment is very less as compared to the responsiveness change in the interest rate. So the change in the investment is not very high in response to the change in interest rate. So the MEI curve is less elastic. Now, what is the distinction between MEC and MEI? A very, very confusing concept for all the ones who are listening to it in one go. I mean, obviously, I mean, I was also confused when I did it for the first time. So let me explain it and try to make it more clear to you. So MEI and MEC is basically, as I told you, investment is affected due to change in demand of capital, due to change in price of capital. Yeah, because obviously, if there is too much demand of the capital, then obviously to control that demand, the bank or the central government, central bank of the countries, they increase the interest rate so that demand can be curtailed, because interest rates is a kind of a cost of the capital. So if the cost of the capital increases, the demand will surely go down. And in that way, investment will uh, obviously be affected in the negative way only. Whereas MEC is investment is affected due to change in the given supply price of capital. What is the supply price of capital? How much for how much you are paying for it, for that particular capital? It depends on the supply, and MEI depends upon the demand of that capital. MEI, it shows rate of return on additional units of capital. What is the rate of return that on additional? Whereas MEC, it measures the rate of return on all units of capital. The formula which I just shared with you in MEC, you can flip back the slides and see it is the sum total of the capital that you are expecting in the whole span of time, whatever time years you have set. So it is not about additional adding towards the stock, it is about the total, some total change in the expected return or supply price that is there. MEI, it's a flow concept, and MEC is a stock concept. Next is MEI. It determines net investment of economy at each interest rate with given capital stock. That is, for each level of interest rate, what is the level of net investment? Whereas MEC, it determines the optimal level of capital stock at each level of interest. It does not measure the change that is occurring in investment with per change in the interest rate. Rather, it measures the change that is occurring in the whole capital stock at each level of interest. So this is what is the difference between the two. And this is all in today's presentation. Thank you for your attention. I hope you have been able to understand the investment and its components. And I have tried my best, I suppose, in making you all understand. It's a confusing concept, but if you keep reading and listening, you will surely be able to know about it quite well. Now, my other presentations will be followed upon the government expenditure, because that's the next component of GDP. Keep following and keep liking the videos. Keep subscribing for my channel, that's Economics to Us. Thank you so much for your patience and understanding. Goodbye.